And hello, BTC Prague. First of all, thanks everyone for being here. I know Michael Saylor is speaking over on the main stage, so I appreciate everyone that sticked around for this. So my topic today is the case for Bitcoin, a store of value and portfolio enhancer. Why is that the case for Bitcoin for me? So I work as a quant in the investment team at a company called AMP. AMP is basically like an Australian pension fund. It's called superannuation fund over there. And we manage around 60 billion Australian dollars in assets under management. And last year we became the first of those superannuation funds to actually invest in Bitcoin. Apart from being the quant in the investment team, I'm also the resident Bitcoin maxi and have run educational sessions in the company all the way from investment team to board of directors and really tried to get everybody on board with Bitcoin and for them to understand the case for Bitcoin and the case that I see for Bitcoin. So the presentation today is a very condensed version of the educational session that I gave internally. It'll be split into 5 different sections. Firstly, I'll briefly talk about what money is and how Bitcoin fits in. I know a lot of people that have studied Bitcoin will know this already, but for those who are new, this will probably be a bit interesting. Then I'll make the case for Bitcoin as a store of value. Then I'll talk about Bitcoin's total addressable market and the adoption trajectory that we're currently on. Then I'll make the case for Bitcoin in a portfolio. And lastly, I'll distinguish between Bitcoin and crypto and explain why it's so important to distinguish between the two. So what is money and how does Bitcoin actually fit in? Now, usually it would be really good to go through the history of money and then get to this slide, but because I don't have time for all of that, I'm just going to talk about the 3 functions that an ideal money should fulfill. And those are medium of exchange, unit of account, and store of value. And the function of money that I want to focus on today is the store of value part, because fiat money, whether it's euro, USD, Australian dollars, doesn't fulfill the function of storing value anymore, because the store of value should retain purchasing power over time. Because it doesn't do that anymore, we've moved on to using other things like shares, property, gold, art, and other collectibles because they retain purchasing power better over time. But none of them are actually really good stores of value if you think about it. They're just other assets or investments that have been repurposed as stores of value. And the case for Bitcoin really is as an emergent store of value in an increasingly digital world. One thing, just to go back to the previous slide, that I sometimes find is that sometimes people focus on the medium of exchange role a bit too much and criticize Bitcoin and say things like, oh, but I can't buy my cup of coffee with Bitcoin yet, so how can it be money? And what they fail to understand is that historically, if you look at the history of money, how a monetary good that has been adopted by the people freely in free market competition has always monetized is by going through the following 4 stages, which is it starts off as a collectible. Once enough people collect it, people see it as a way of keeping and storing value, and its purchasing power will rise. Only once it becomes a stable store of value will people actually use it as a medium of exchange and demand it as a medium of exchange. Once it becomes a medium of exchange, it usually becomes a unit of account basically straight away. And where we most likely currently are with Bitcoin is it going from being a collectible to being a store of value, and more people seeing it as a store of value. But the transition to being a stable store of value can take decades or even centuries. For gold, this took a really long time, but obviously with gold we didn't have this hyper-connected, global, fast-paced world. So for Bitcoin, this will likely happen a lot faster. So just to reiterate the point, an emergent store of value in an increasingly digital world, that's the compelling investment thesis that I see for Bitcoin and that we see for Bitcoin in AMP as well. Now, I'm sure a lot of you would have seen this before. This just shows that even the strongest of the fiat currencies, the US dollar, has lost around 96 to 97% of its purchasing power over the last 100 years. Again, just making the point that fiat doesn't serve that function of storing value anymore. Okay, now moving on to Bitcoin's case as a store of value. The best way to think about this is to go back to first principles and really think about what actually makes a good store of value. What are the properties that an ideal store of value should have? And all of you can go through this exercise in your own time and actually think about what properties would I give a store of value to make it as ideal as possible. The properties that I've listed here are the following. There should be no inflation possible. It should be divisible, liquid, portable, have no or low cost of storage. No one should control it. It should be durable, verifiable, fungible, and have an established history. Now, the interesting thing, if we actually rate different stores of value that are commonly used nowadays and Bitcoin on these properties, then what becomes clear is that Bitcoin clearly outperforms all other stores of value from first principles on these key properties. And with the rating here, I actually try to be as critical of Bitcoin as possible. There could be more 5s in the Bitcoin column as well. Now, one criticism that I often hear is, well, I understand the list that you just showed, Jonas. I would agree with that, but aren't you missing one key property of a store of value, which is stability? It's supposed to store value over time, after all. How can Bitcoin potentially be the perfect store of value if it's so volatile? And my response to that would be that volatility is not an intrinsic property of anything. Nothing is inherently volatile. It's more a consequence of how we humans interact with it and how we trade Bitcoin. And stability would be the result of something being an established store of value with the best store of value properties. And broad adoption, liquidity, and market confidence will get us there. Now, the chart that I'm showing here is the Bitcoin price in orange and the 1-year rolling volatility of Bitcoin in yellow. And as you can see, over time, the Bitcoin volatility has already been coming down a lot, and it's now roughly in line with Tesla or Nvidia, which are commonly held stocks. And you would expect this to decrease further as Bitcoin adoption increases over time. Now, one ethos that I'm sure everybody here has heard a million times at this conference is don't trust, verify. In Bitcoin, we can verify everything ourselves, but I want you all to apply the same principle to everything that I'm saying here today. Don't just take my word for it. Really try to go through this exercise yourselves and think about, if I could design the most perfect store of value, what properties would I give it? And then I'm sure you'll get to a similar conclusion. Now, let's look at Bitcoin's total addressable market and the adoption trajectory. The case that I just made for it being a store of value makes the case that Bitcoin is a better store of value than all these other stores of value that we're currently using. And if that really is the case, you would expect Bitcoin to capture a lot of the value that's currently sitting in these other stores of value. But what actually is that total addressable market of storing value? If we sum up the different assets for storing value nowadays, and these numbers are a bit outdated, gold's market cap is a lot higher than it is in this table, but the logic remains the same, then that gives us roughly $900 trillion US. And if we assume that around 50% of that represents monetary premium or store value function, that's still a total addressable market of $450 trillion US. And if Bitcoin really is the superior store of value, you would expect a lot of this value to be captured by Bitcoin. And let's just say maybe 10% of that flows into Bitcoin. What would that look like? That would still be $2.14 million US per Bitcoin. Now, the way that the person who created this table actually did this was they assumed different capture percentages by Bitcoin of each of the different markets and did a bottom-up summation, and they get to $10 million per Bitcoin. So I'm definitely being conservative compared to what this is showing. Another way that you could look at this is, what if Bitcoin only competes with gold and breaks even with gold's current market cap? That would still be roughly a 10x or $1.1 million per Bitcoin from here. And now some of you, especially if there's any gold bugs in the audience, might be thinking, but that sounds a bit crazy. Gold has been around for thousands of years. Central banks all over the world hold gold. Surely Bitcoin's not going to break even with gold's market cap. Let me show you two charts that show the current interest in Bitcoin versus gold based on the ETF numbers. The first chart here, and this only goes up until the end of last year, is the assets under management for BlackRock's gold ETF versus the Bitcoin ETF. And as you can see, the gold ETF took around 20 years to accumulate $33 billion in assets under management. But the Bitcoin ETF accumulated almost double that in the first year alone. And if you just look at these two charts side by side, it's a completely different story. Another interesting thing you can look at is if you look at the total ETF inflows by year, and gold's numbers are inflation adjusted here, so this becomes somewhat of a relevant comparison. The interesting thing here is obviously Bitcoin completely outperforming in year one, way bigger inflows than gold. But for gold, we saw higher and higher inflows in each consecutive year after the initial launch. What if something similar happens to Bitcoin and we also only see higher and higher inflows? What would that do to the Bitcoin price? Now, one thing that I saw on X that I really liked for the adoption trajectory is this comparison, which just compares the Bitcoin adoption to the internet adoption based on the number of users. And as you can see here, this only goes up until 2023 for Bitcoin. But in 2023, we were roughly in line with 1999 in terms of the internet adoption. So that currently puts us maybe in the year 2000, 2001. And there's also estimates that there are currently around 400 million unique users of Bitcoin. But how can we put that into perspective? What's the total adoption of Bitcoin look like? If we assume that Bitcoin has a total addressable market of 4 to 5 billion people worldwide with access to the internet, smartphones, and a need for a digital, censorship-resistant, global, decentralized store of value and payment system, then 400 million current adopters represents only 8 to 10% adoption. And I actually think that that's probably overestimating the adoption, but let's be conservative and go with that. If we look at the typical S-shaped adoption curve, that puts us where I'm pointing with the arrows here, which is still in the early adopters phase at the point where the slope of the curve hasn't even really taken off yet. So this probably represents a really big opportunity as well. Now, one thing that I always include in my presentations is Bitcoin's role in a portfolio. So I tend to explain everything to institutional investors and finance professionals using the following two slides. Bitcoin basically has two really strong cases for institutional investors to adopt Bitcoin. The first one is Bitcoin as a unique diversifier. BlackRock actually put out a paper last year called Bitcoin a unique diversifier, and I've borrowed some of the stuff from them. But the charts that I'm showing here, the first one, the top chart, just shows the correlation between Bitcoin, gold, and the S&P 500. And what you can see is that both Bitcoin and gold move through different phases of being slightly positively correlated with the S&P, slightly negatively correlated, or uncorrelated. But over the long run, the average correlation between both Bitcoin and gold and the S&P is almost zero. So they're really uncorrelated to the S&P 500. If you look at the bottom chart, you can see Bitcoin versus the S&P versus gold and versus bonds. And the story is the same. It's really uncorrelated to these traditional assets that you find in typical diversified portfolios over the long run. And if you think about why this is the case, if Bitcoin really is this global, decentralized, censorship-resistant, non-sovereign asset, you would expect it to have distinct risk and return drivers to these other traditional assets that you typically have in your portfolio. And therefore, it should be fundamentally uncorrelated over the long run. But why is this uncorrelatedness so important? It's important for the following reason. If you actually model a 1, 2, and 3% allocation to Bitcoin in a diversified portfolio like the typical 60-40 portfolio, then what happens is the return of that portfolio goes up a lot. But the key point that I want you to understand here is that the volatility, as you can see, the annualized volatility only goes from 9.5 to 9.6 when you go from 0 to 3% in Bitcoin. So the risk-adjusted return, what we call the Sharpe ratio, also only increases. And the reason for this is that, yes, Bitcoin is super volatile, but it's volatile to the upside. And if you have an asset that's volatile to the upside, which means it has a positive expected return, and it's super uncorrelated, which I showed in the previous slide, then when you add it to a diversified portfolio at such small allocations, the volatility basically gets diversified away, and all that you're left with is the excess return. Now, the last thing that I always do here, and I'm actually running a bit faster than I expected because I knew that I didn't have much time, is the distinction between Bitcoin and crypto. And the reason why I do this whenever I do educational sessions is that both Bitcoin and crypto, or cryptocurrencies in general, are really new assets. And a lot of people, and especially the media does this a lot, but a lot of people still put them in the same bucket. But this leads to a lot of the negative properties of crypto being transferred over to Bitcoin in people's heads, and maybe even a lot of the positive aspects of Bitcoin being transferred to crypto, but separating out makes a clear distinction between the case for Bitcoin and crypto and why they're actually different. Now, what I'm doing here is I'm just contrasting Bitcoin to Ethereum, but a lot of the stuff that I say about Ethereum can be generalized to other crypto assets as well. The key thing that I want you to understand here is that the value proposition is completely different. For Bitcoin, it is this internet-native global monetary alternative and store of value. Everything that I previously said only applies to Bitcoin. It doesn't apply to Ethereum or any other crypto asset. Because Ethereum tries to be a programmable platform for decentralized applications. And then there's other crypto assets that try to be the rails for stable coins or Web3 applications or NFTs and all those other things. So at best, you can think about them as tech providers, but Bitcoin is really the thing that matters here because it's trying to solve a real problem, which is the broken money that we have all over the world. The other thing that I want to highlight here is the level of decentralization. So Bitcoin is super decentralized and is getting more and more decentralized over time, whereas Ethereum and other crypto assets tend to be quite centralized. They tend to have a pre-mine as well, where the founders basically enrich themselves. And because they use proof of stake, it tends to be centralizing over time. So the more tokens you hold of other crypto assets, the more voting rights you have in that system, which is not the case for Bitcoin. And for me, one thing that's always really helpful for traditional finance investors is the TradFi comparables in the end here. For Bitcoin, I tell people that they can think of this kind of like gold, but in a digital way, just with better properties or alternatives. And for Ethereum, it's really more venture capital investing, early stage tech startups. So the key point that I want to get across here, and I make this point all the time, and I reiterate this so many times, is that blockchain is not the innovation here. Bitcoin is. Blockchain was just one of the pieces to the puzzle to make Bitcoin work. But because that's the case, that doesn't mean that you can just take a blockchain and build other things on it and they automatically become decentralized or valuable. So again, Bitcoin is the innovation, not blockchain. With that, thank you everyone, and remember, stay humble and stack sats. Thank you.
Secure your BTC Prague 2026 ticket at the lowest possible price now.